Welcome to SK Compete.
Hi friends, welcome to today's class. Today we are going to see about inflation. What is inflation actually? Inflation is nothing but increase in prices. So it's about increase in price of what? It is food, transport or energy. It is increase in price across the economy, not a particular item. Overall, there is increase in price level in the economy. So there are various types of inflation. Now we'll be seeing the major types, demand pull and cost push. So first we are going to see about demand pull. From the name itself we can make out, if there is increase in demand, then you call it as demand pull inflation. So this is the scenario. For example, you wanted to get a cycle from a shop. Initially, only few members wanted to get it from a shop. That time the price of the cycle is 2000. Say it, this is in the year 2019 or whatever you name it in a particular year. After that, there may be increase in demand by n number of reasons for this product. For example, say there is pollution rising everywhere. So many want to cut down in the fuel cost also, and many are aware of this pollution also. So they might prefer cycling to a nearby distance and the associated health benefits also. So there is a demand rise for the cycle. This is just an example for any product, name it. There will be some other reasons for the price rise also. So if the demand is increasing, you see many are waiting in the shop. Gradually, it's quite natural that if demand is increasing for the product, there will be a rise in price. So when demand for goods, services, it's not only about goods. It also includes services also. When this exceeds the production capacity, then it's called demand pull inflation. This is the one scenario. Name it. The other scenario being, you have been come across in the news semiconductor chip shortages. This is regarding what? This is in car manufacturing industry. So, car manufacturing industry, when this is what actually, this is a raw material required to make a car. If this price is, if there is a shortage of this and because of that car price is increasing, do you call that demand pull? No, this is not demand pull, which we are yet to see. That is cost push, that we'll see in detail. This demand pull is only because of increase in demand. Now only we are coming to cost push. So here the demand is the same. There is no increase in demand. But because of the increase in cost of production, prices increases. Say for example, there is a chai wala. So he makes tea. What is the raw material for this tea? That is from milk. So initially he used to have 2 cows or few cows to get milk from it, or he purchased it from a nearby. But that is being closed, the nearby place is closed, or he has sold his cows for some other reasons. So he is unable to get it in the nearby places. So he has to transport the milk from other places which are little far away because he is unable to get it nearby. So because of this, here transportation cost is included. That is also a cost of production. So when that increases, eventually price of cost push inflation will be increased. Here we are talking about supply side. Supply side, if there is some issue happening, the prices increase. That is cost push. So now we'll see the difference between demand pull and cost push. So caused by expanding economy, increased government spending or overseas growth. So this is, they are telling why this increase in demand happens. So economy gradually, like many are getting job, they are earning more, eventually the demand increases. And if government is also spending more, you'll have more money in hand. So then you'll go for to buy some product. Then also this demand will increase. What is cost push? That is by increase in cost of factors of production, as we have already seen, labor, capital, land, be it whatever. So even if wages also increases, final product of it will increase. As we have seen, cost push, as I was talking about semiconductor chip shortages, the car manufacturing prices have increased. That is a factor of production. So eventually car prices are getting increased. That is not because of only of demand. Demand is the same, but cost of production has increased. So here aggregate demand is increased. Here aggregate demand remains the same, but other cost of factors of production are increasing. So what are the best example for this? When this demand pull, we already seen expanding economy, all demand for goods rise sharply. Post COVID recovery, this demand has risen. How can you tell it's post COVID recovery the demand has risen? We'll see in next slides. Cost pushes, 1970s oil crisis, because this here oil is being increased. Russia-Ukraine war. So Russia-Ukraine war is happening. Ukraine is a major exporter of wheat. So wheat prices are increasing. And Russia is a major exporter of oil. So there are sanctions on Russia because of waging war against Ukraine. So oil prices are also increasing. So this is the case because of cost push. This post-COVID recovery we'll see in further slides. So other thing, heat wave scorches wheat fields in India, reduces yield and threatens export plans. So what do you call this? Demand pull or cost push? Demand pull or cost push? This is cost push, because supply side we are not talking anywhere about the demand, because here supply side heat wave is being hitting the wheat fields in India. So wheat yield is obviously the yield is reducing. So supply is getting reduced here. So obviously cost will be pushed. Then the government will, for example, if you see the data in government website, the wheat post this heat wave was also major reason. Russia-Ukraine war also. Now if you see 37 per kg atta, refer government website, this October 2022, this is the average price for wheat. This is averaging of all states, then you get this average price. The same thing last year, 30 rupees was its price year ago. So there is a rise of more than 20% price rise because of this Russia-Ukraine war and even heat waves. This is seasonal, because heat waves will hit the crops. Okay, now we have seen that like examples like chai wala, we have seen it, cycle, cars. So what constitutes, we say that inflation, prices are increasing. So what are included in that? How will you calculate that? For that you have two indexes in India. One is wholesale price index, other is consumer price index. Wholesale price index, this is based on wholesale rate. Here you have primary articles, fuel and power, manufactured products. So every goods is covered here. Fuel is also covered, manufacturing, so TV, car, electronic devices, whatever you can manufacture, that is here. Primary articles will be food, rest things will be covered here. This does not include services. What are the services? For example, transport, education and personal care is not included in this wholesale price index. This is majorly dominated by, so you can see manufacturing product in weightage is 64.23%. This is released by Office of Economic Advisor, Department for Promotion of Industry and Internal Trade, Commerce Ministry. So because we can't know if one individual price is increasing, we can't tell it's an inflation. We need some data for that. So that data is this wholesale price index, one of those indicators to measure inflation. Though this includes n number of items. This does not include services. So next is consumer price index. You can see here, this is the index. You have food and beverages, pan, tobacco, intoxicants, clothing and footwear, housing, fuel and light, miscellaneous. So this you have services also. Miscellaneous is services. So services also included here. Food and beverages occupy majority of this. This is released by National Statistics Office and Ministry of Statistics and Program Implementation. So this is dominated by price of this weightage is 45%. They are manufacturing goods. This includes services also. Base year is 2012. Say for example, food prices are increasing. That will be shown much where here the weightage is more. So if food prices is increasing, CPI will increase. If food price is increasing, CPI will increase. Suppose manufacturing products like you can see televisions, those are increasing, which will increase more. This will also increase, but majorly which will increase? Wholesale price index, because the weightage more is given to manufactured products. Okay. Now because of this inflation, what and all will happen? We know prices are increasing. But what will happen because of this? First, it will erode the purchasing power. What is this purchasing power? So, with 100 rupees, for example, I am telling, with the given money, how many products you can get? That is like how much you can purchase. That is the purchasing power. For example, you see, you take 100 and go to a shop. Earlier prices were less. For this 100, see, for example, you take a balloon. Earlier it used to cost 5 rupees. So you can get 20 balloons. Now for example, see the balloon price has been doubled to 10. So now with 100 rupees we can get only 10. So the purchasing power with the given money, here you can get more earlier when there was no inflation. Not no, when the inflation was less. Now we can get only 10. So it erodes the purchasing power. So it hurts the poor disproportionately. So when inflation is happening, majority of it will be food also and fuel also. Both are major part of everyday activities. So poor will already be having less money to spend. Again, increase in prices will hurt them more. It increases cost of living. So all this housing prices, rental, all will get increased. So everyday expenses are increasing. So this will increase cost of living. Hurts businesses due to rising raw material and production cost. As we have already seen, when raw materials are all in shortages and those prices are increasing, so it will hurt the business. Though business will tend to give that amount to final end consumers, but still they will bear some amount. So that will erode their profit. So then they will take down these measures to cut down the production capacity and which workforces are all not required. Then comes unemployment. As you have seen frequently in the news about layoffs, like major companies like Meta and Amazon are also laying off. Because of this inflation, this business profits are also reducing. So inflation doesn't affect only individual, it also affects the businesses also. Now impact on borrowers. So what is this impact on borrowers? What will happen? The general thing is, you'll say if there is an inflation, borrowers will also be affected more. But this is a different scenario. See, you're purchasing a TV in 2020. For borrower mean, see, for example, you're purchasing the TV for 1 lakh. Say, so you don't have it, you're borrowing from someone. So you're a borrower. You say you're borrowing for a 3% amount. So in 1 lakh, what is 3%? So for a year. So at the end of 1 year, you have to pay to the borrower 1 lakh and 3,000. Right? So you have to pay this amount. So he will be getting 1 lakh 3,000. For example, 2021. The price of this TV has been increased to 1 lakh and 10,000. That is 1.1 lakh. This is 1.03. This is 1.1 lakh. Now who will be in the benefit? Now the lender will be getting at the end of 1 year, he'll get only this much. By the time, see, the prices have increased to 1.1. So the borrower will be benefited by this. If the lender wants to buy the TV at that time, it could have costed him more than the interest which he earned on it. So this inflation allows borrowers to pay lender back with money worth less than when it was originally borrowed, which benefits borrowers. So because he got it 1 year back with less amount because of less inflation. So this is how it helps the borrowers. Next, you can see India's 12-month inflation rate trend. See, 2020 gradually approached 2021, it has been reaching its peak, 6.95% in March 2020. Then it peaked to 7 point something also. So inflation been increasing. So already we saw when reading this demand pull, post-COVID recovery. So what do you think this inflation has caused? Why this inflation? Because post-COVID, there is strong economic growth was back and so was inflation. Because during COVID time, everything was closed. There was no demand. The demand was very less. After post-COVID, there was a vaccination rate increased, everything reopened. So in a fraction of few days, everything got reopened. So suddenly the demand was increasing very hugely. So you can see retail inflation in India surges to 8-year high of 7.79 in April. So this time what we had, will you call it as demand pull or cost push? It is combined of both. Nobody knows that because demand is sudden demand, increase in demand post-COVID opening of stores. Then the supply chain got disrupted because of Russia-Ukraine war also, and China is also maintaining zero COVID policy. So in Russia-Ukraine war, Ukraine ports were all closed. It was not possible to transport from Ukraine. There were sanctions on Russia also. So these are all contributed to supply chains. RBI's emergency meeting. Central bank in tight spot over steep interest rates and rising inflation. What is the steep interest rates? So we'll see about that now. So rising inflation. How will you control that? Let's see about this now. So measures to control inflation. So monetary policy. So this is being done by RBI, Central Bank of India. For that they have Monetary Policy Committee, which is headed by RBI Governor. This Monetary Policy Committee is headed by RBI Governor. So these are the various measures to control inflation. Statutory liquidity ratio, cash reserve ratio, repo rate, reverse repo rate, market stabilization scheme, open market operations. Now we'll see first thing, statutory liquidity ratio. So now who is going to control this inflation? Central Bank, Reserve Bank of India is going to control the inflation. So if it is demand side, the demand, these things all will work. This monetary policy, this thing will all going to work for demand side. Supply side have to individually taken care of. If there is a Russia-Ukraine war, how that process, that will have an impact. Because of heat wave, wheat yield is reducing, so there has to be R&D on how to cope in periods of heat wave. So supply side have to be dealt differently, but this time there's a mix of both. We are not aware of exactly which caused this inflation. So this RBI tackles it with monetary policy, which is used to tackle majorly demand pull inflation. So one among that is statutory liquidity ratio. What is this? This is that commercial banks are required to maintain in the form of cash, gold reserves, government bonds and other RBI approved securities before providing credit to the customers. So every bank, you know how bank functions, every bank will have their own assets. So that's what we'll be seeing as demand and time liabilities. So what is time liabilities? Liabilities with the commercial banks are liable to repay to the customers after an agreed period. This is fixed deposit. What is demand liabilities? Immediately when the demand rises, we have to repay the customers. That is savings account or current account. So every every bank will be having this assets. In this, certain percentage of it, this banks have to keep it in form of cash, gold reserve. They have everything. So bank will have cash also, they'll have gold reserves also, government securities and government bonds also. Government securities we'll see in further slides. What are government securities? So they'll have to keep with them. So what will happen if they keep these all with them instead of lending it to customers? So see, if everything is being lent to customers, so you'll have money supply increases, right? So money supply overall will increase in the hand of people. What with the money, what you'll do? You wanted to buy something, so demand increases. When supply does not meet with demand, if the demand is surging very quickly or rising sharply, that will lead to this. So instead of lending every money, they have to keep some portion of it in reserves. Suppose there is an inflation, then what you have to do with already have some percentage of reserves with RBI. This commercial bank will keep it with them according to RBI's instructions. So when there is an inflation, so they will increase SLR. So what they have in this cash and gold reserves, all they're increasing. So then what will happen? Say for example, say a name, or they have 1 lakh crore. Say for example, X bank's liabilities. So government says 4% of it has to be kept in form of cash, gold. So rest of that only will be available for lending. Now during inflation, it's been raised to 5%. So what they will lend to customers will reduce. So when then lending reduces, because through bank only money is being flown to everyone. So when this reduces, overall money supply will get reduced, then the demand will automatically reduce, then inflation will be reduced over a period of time. So is this the only way? No. Next is cash reserve ratio. What is this cash reserve ratio? This is the share of bank's total deposit that is mandated by RBI to be maintained with a later as reserves in the form of liquid cash. SLR is to be kept with bank themselves as instructed by RBI. This they have to deposit to RBI. So during inflation, what we have to do? What the RBI will do? Will increase CRR, cash reserve ratio, so that their lending amount will get reduced, money supply will reduce in demand, which will eventually reduce inflation. Next, repo rate. This is what frequently talked about. So central bank, RBI will. So this we talked about monetary policy committee. This monetary policy committee needs to determine this repo rate. This is also called as repurchase agreement. So this is the rate at which central bank of the country lends money to commercial banks. This is not what commercial bank is lending to customers. This is so this commercial bank also will go shortage of money. They also will borrow. From where they'll borrow? They'll borrow from RBI. So that rate is called repo rate. So when commercial bank is borrowing from RBI rate increased, that will pass on to customers also. That is linked. Now bank rates, everything is repo linked. I'll show you how it is. During inflation, certain central banks increase repo rate, as this act as disincentive for banks to borrow money from central bank, and thus reducing. A main aim to tame inflation is to reduce money supply. Say for example, you have taken a home loan. You have taken a home loan at rate of 7%. Now, because of inflation, this central bank has increased the repo rate by 50 basis points, means nothing but 0.5%. It has increased it. So RBI to bank. So how will it affect us? So bank is lending home loan or car loan, whatever, at 7%. So that 0.5 will get increased to customers. Directly it will get in few days. So it is directly linked nowadays. So that is the reason this RBI Governor Monetary Policy Committee meets and decides this repo rate. When there is an inflation, they will increase this repo rate. And what is this reverse repo rate? When bank is shortage of money, they borrow. When they have excess money, they will park it in, they will deposit in RBI and earn interest on it. That is reverse repo rate. So what will happen, say for example, the repo rate is 4% and reverse repo rate is 5%. So instead of lending, all this bank will go park its money in RBI and earn interest on it. There is no purpose of bank to people at all. So RBI has made it clear that usually reverse repo rate is less than repo rate. So that bank, when really they have surplus fund only, after lending, they will deposit in RBI. So it is, if repo rate is 4, reverse repo rate has to be less than repo rate, which is 3% or something like that. So next is open market operations. So what is this open market operation? This is conducted by RBI by way of purchase and sell of government securities. So what is this government security? Government security is treasury bills, cash management bills, bonds. So to adjust the liquidity conditions in the market, that is money flow. Liquidity is nothing but money supply in the economy. So suppose you are buying a bond. Why will you buy a government bond? It says that it will return for X percentage, 5% after X years or months. So name it 5% after 2 years or a year. So you are buying a bond in that. So when you buy, the money will go to RBI, because RBI is only conducting that auction through e-Kuber and core banking platform. So that time what will happen? Money supply will reduce. So this is a condition to tame inflation. So when you are buying, who has to sell? RBI has to sell it. So when there is excess liquidity, it restores to sale of securities. Suppose when liquidity conditions are tight, so it will buy from the people. So this can be bought by individuals. This GSEC can be bought by individuals, trust institutions also. By institutions also. So it will buy back the securities from the market to increase money supply. So we have seen now what are the monetary policies to control inflation. So what are the other things available? Reducing import duty, excise duty cut. For example, what's excise duty cut? You have seen on fuels. For diesel and petrol, then obviously the price will come down. If you reduce import duty, for example, on steel prices will come down. So to tame the prices of particular commodity on supply side, government restores to this duty-free imports, banning of exports. For example, wheat yield has reduced because of heat wave. So when there is less supply here and when the demand is more, the price will obviously increase. So we have to ban exports. So only domestic demand will be met. So banning of exports is also one kind of measure to control inflation. And increase tax. If you increase tax, the money with people will will get reduced, will reduce the liquidity, reduce spending. For example, during COVID time, the government announced many physical policies. So that in turn led to increase in demand also. So to tame that, it has to reduce spending. So now we have seen what is inflation, what is demand and cost pull inflation, and we have seen what are the effects on inflation on people and how to control it and what role RBI plays in this. Thank you for watching this video.